Hi, everybody. Aman Behzad here. I've got a few slides to go through talking to you about banking as a service. I'll contextualize some of the things I have to say in a second. Just quickly on our firm, we're a corporate finance advisory firm. We support companies on capital raising and M&A activity. We've completed 40 transactions in the 4 years that we've been around. We are the most active fintech advisor globally, supporting the financial technology industry. We've done deals as far east as Australia, as far west as Chile. Very, very active. Won't spend any more time on the company's propaganda. Just by show of hands, before we go into banking as a service, embedded finance, who has heard of the terms BaaS, banking as a service, embedded finance? Okay, so it's a pretty, okay, good. So I'm not, okay, I understand the level then. I think the first thing to go into this, before I sort of go into the way in which BaaS and banking as a service and embedded finance is evolved, is just to sort of replay back where this really came from. I mean, 2008, financial crisis happened. I think we all had a bit of a rude awakening as to how bad the service level was. Everything sucked. Getting a loan sucked. Making a payment meant you had to go and queue up outside your bank to make a physical payment to pay your credit card bills. Everything was just terrible. Massive amounts of friction. People didn't have time. Our employers were trying to squeeze more and more work out of us, and we just had less and less time. And so there's this massive call towards efficiency. And finally, for the first time in a very long time, we had these wonderful tools, digital innovation, to really facilitate that process. And we had a confluence of banks letting go of huge amounts of technology talent, and then a huge amount of university graduates coming in with a first principles approach to trying to solve old world problems. And that's really where we saw embedded finance and BaaS really coming to fruition. We've all had some BaaS experiences, whether we know about it or we don't. We've all used an Uber, I'm sure, or other ride-hailing app at some time. There's been a payment that's been done there on an embedded basis. We've gone and shopped online at Boohoo or somewhere else like that, and we've seen a BNPL option at checkout that we may have availed out of morbid curiosity or indeed actual need for funding it. And we may have some pension products that we have, an app. We may have something like a free trade where we're buying and selling stocks and shares. So we've all had some kind of experience of really cool technologies around fintech and financial services. If we just spend a minute or two talking about the traditional banking models first, you really had a bank, used to take 2 years to produce a new credit card offering, sometimes 3 years. There'd be a program associated with that, be it mileage, there'd be a pricing, cashback, all kinds of other interesting things. By the time that product would have been launched, 2 or 3 years would have transpired, and effectively you've missed the market. What BaaS enabled these banks to do was for the first time partner with, was for the first time put together effectively a regulated entity with a technological capability and allow you to go to market and produce products at a much faster pace and at a much more innovative speed than what was historically possible. And that was really what we call the kind of classic BaaS model. When we think about embedded finance, it's really putting together 3 things. It's taking together the regulated status of a bank, the technology capabilities that are on offer from a financial technology company with modern engineering and a modern platform, and embedding those within an application, an e-commerce transaction, a mobile transaction, such that you don't actually see or feel the fact that you may be committed to a financial transaction per se, and it's certainly not been something that's been separated. It's all within a single workflow that you've seen it in action. If we look at the pros and cons associated with this, so businesses, they reduce the fundamental time to go to market when it comes to launching new products, as I mentioned earlier. They can actually have access to financial services revenue. So giving you a real-world example, let's say you're an expense management company. You sell to corporates their ability to track their expenses. That's a great tool, but wouldn't it be great if you could put a debit card in the hands of their employees, and every time their employees spend something, you get some interchange off the back of that? Well, as an expense management company, you then have to go through the process of getting regulated, find a card sponsor, team up with them, go out to market and try and push your credentials, and then obviously you're bearing regulatory risk associated with having this regulated financial product out there. And it would have probably taken you 2 or 3 years to go through all the hoops and sinking capital into getting yourself the status that you need to be able to offer those cards. Well, if you partner up with a fintech company, a BaaS business, you actually can offer an embedded finance offering whereby you can get a cut of the interchange. I mean, in the US, if you look at a typical card transaction, you're still getting around 200 basis points. Typically, an expense management solution can split that 50-50 with their BaaS provider. So suddenly, a BaaS provider gets revenue, the financial services company gets access to a new revenue, a new channel, and the the e-commerce company, the technology provider can suddenly get access to new revenue that they don't carry the risk of the associated rigmarole around being a regulated entity and everything that entails. It obviously increases client retention. I think if you look at your credit card offerings today, having something like a priority pass now is sort of table stakes when it comes to having a good quality credit card offering. So there are certain levels where the very facilitation of financial services within a regular commerce transaction that you may have been exposed to suddenly becomes a table stakes, a minimum requirement that your vendors have. They don't want to have multiple vendors. They don't want to have multiple vendor risk. They just want to have one person that they interface with, one person who invoices them, and have that one counterparty that they work with, that one supplier. And then in terms of the banks or the financial services organizations, the institutions that they lean into, obviously I mentioned before, additional revenue streams, better customer acquisition and retention for customers that may have been quite flighty and switched from one platform to another because it's an embedded solution. And then just effectively making sure that financial institutions continue to be relevant in an era where fintechs are really taking over. If we look at the sort of the BaaS and the traditional value chain, we've got along the top here an illustrative example of what would have happened if you had undergone a regular, let's call it a lending transaction in this case. You had a business, you would, they would effectively apply for an application to complete a loan, some kind of lending product. That would go onto a platform. That platform would then effectively mail that lending requirement to the bank. The bank would probably come back with some paper-based forms, send those paper-based forms back to the business, and then the business would send them back and then ultimately look to get approved for a loan. The embedded finance value chain radically reduces all of that friction. So at the point of opening up your ERP system, your accounting system, you can instantly say, I want to factor this invoice, and then boom, like that, in a seamless process, you've been credit scored, you've been assessed, the amount of counterparty risk that the bank or the financial institution at the back end is willing to take has been assessed, and that money has ended up in your bank account before the end of the day. That is basically a massive reduction in the level of friction, and that is an embedded finance value chain. If we look at how embedded finance, BaaS, et cetera, has morphed, BaaS 1.0, BaaS 2.0, and what I like to call BaaS 3.0, which is embedded finance. 1.0 was really about typically bank-regulated credit card companies offering co-branded tools. That was sort of the basis of BaaS. So if you were B&Q and you wanted to have some kind of loyalty card that you had for your customers, you could give them that loyalty card. You would be a co-branded product, so B&Q would be on the card. You would get some kind of cash back, discounts, etc. And that was really BaaS 1.0. The financial services counterparty that you had, in this example, Green Dot, would be providing you with banking coverage. They would be managing the credit and the regulation side of things. You would have a co-branded front-end interface, but really nothing else at the back end that really tied you two together. You'd still have a very separate relationship between the lending partner, which in this case would be Green Dot, and B&Q or Kingfisher Group on the other side, where you saw them in terms of buying products from them and getting discounts. 2.0 is, I guess, what's been popularized today and what we have now. So you've got technology companies that are regulated entities that are offering cards as a service, that are offering apps, that are offering API connectivity to be able to offer financial services products as you all consumed them in the past. And then you really have BaaS 3.0, which is, again, talking to the fact that things like wallets, ability to offer ledger accounts, these are held within the end customer, the end interface, the user experience that you're looking to have in terms of the retailer or the e-commerce services provider. So an example would be you opening up your Amazon account and already seeing that there's a discount voucher there from a cashback that you have. That's an embedded finance experience. You haven't needed to go and separately redeem a voucher, plug it back into the platform, and then go through the rigmarole. You've actually got effectively an integrated wallet sitting right there. If we look at sort of developments that are going on in the sector, as we have this next leap forward, there are a lot of platforms and technologies that are being tested in terms of their resilience, in terms of their ability to handle the new embedded finance 3.0, BaaS 3.0 paradigm. And that's led to a number of businesses, a lot of the sort of slightly older school fintech companies like FIS, and actually even Marketer I'd probably put into this bucket, recognizing the fact that their platforms are somewhat limited in terms of the technological innovation that they can go. They can still patch together modern-ish systems to give them the kind of result that some of their clients are looking for, but in a new era where you're looking to be able to offer a much deeper, much richer customer experience, they just don't have that technological DNA anymore. And so they're having to make acquisitions, and we've seen that with Power Finance being acquired in the US by Marketer, Bond being acquired by FIS to really power their BaaS propositions. The nature of the confluence between a technology business and a regulated business obviously will also lead to some broken glass. That comes from the fact that a lot of the people who ended up leading the charge in the fintech world were technologists first and really took the approach that we'll ask for forgiveness versus asking for permission. Now that works in many circumstances, but sadly not with the FCA and not with the Bank of England. You've seen that with regulators across Europe where they've started to really clamp down on these propositions where there was a lot of innovation going on. I think after the global financial crisis, regulators really wanted to create alternative financial systems. That now has gone through the motions, and there's been a lot of tightening of the net. I think a certain amount of waywardness on the part of these fintech businesses was permitted, no longer. You've seen it in Germany, where Solaris, which is a very, very well-known banking and service provider, has been looking to, I think, publicly raise money for its business. They've had issues with BaFin in Germany, which I think are quite public. You had Railsbank and quite a public affair there in terms of how they were interacting with their clients and what the regulatory impositions that were being put on their business. The same with Modular, just very, very recently. There is a long list. I think a lot of people have sort of put a foot wrong, fallen foul of the regulators. Some of them will be able to correct course, and typically involving beefing up their own KYC capabilities, their recording capabilities, some of the rigor and scrutiny by which they settle funds and how they settle funds and the processes associated with them. But some of them will not. They just will lack the ability to be nimble enough and move quickly enough to be able to adjust to a new reality of a much more activist regulator. And I guess just to finish off, some key challenges in the BaaS space and embedded finance space and some key opportunities. I think, firstly, key challenges. It's obviously becoming an incredibly competitive and crowded landscape. There are a lot of people who are rebranding themselves or calling themselves banking as a service providers, offering payment cards, accounts, some of them offering multi-back-end credit as a service. Hard to differentiate what their capabilities are between all the different ones that exist. And the second thing is macroeconomic challenges. The massive push towards digitization and more seamless and better financial services is obviously predicated on there being money in the tank to be able to fund and acquire these new platforms and these new capabilities. That's taken a bit of a battering. I think if we're not in an actual recession yet, we're certainly in a bit of a software recession at the moment, and that's pushed out sales cycles of new lending platforms, of new innovative BaaS platforms. And obviously fundraising hurdles exist in the current market environment as well. In terms of opportunities, I think I already mentioned consolidation among the space. I think because of that lack of clarity around proposition, some businesses who struggle for differentiation will be acquired, and I think a number of the large strategics will actually reach out and try to modernize their platforms by making acquisitions. I think the ability to reach into a wide range of segments and industries in the BaaS space is coming. I think today, if you look at some of the core areas, retail is starting to get has been targeted very significantly. Travel is being targeted, but there are many, many sectors that remain fundamentally under and unpenetrated from a banking as a service perspective. And then we all talk about the size and market opportunity, and we can all commission a McKinsey report that'll tell us it's 10 billion or 20 billion or 30 trillion or whatever the number is that people feel like shooting out with. But the whole point of embedded finance is the reduction in friction leads to an ability to transact on pretty much everything that you do, and an ability to collect a revenue share and create revenue pools for, as I said, financial services companies and core businesses that they serve. And that's really banking as a service and BaaS in a nutshell. Should we shoot with any questions, or would you like to come up and compare? Okay, very good.
Thank you, Aman.
Sure.
So just a few questions there. Now, if we do have any questions from the audience, if you want to put your hand up, you might need to shout, but put your hand up and we'll try and get a microphone to you maybe. Okay, I'll go with the questions that have come in from our virtual audience. So thank you for sending those in via the app. 1 second. Okay, so obviously you've talked about banking as a service, or BaaS here. Can you elaborate on some specific industries where the integration of BaaS has shown particularly transformative advantages?
Sure. So I think travel, for one, is a really, really interesting and applicable use case, where essentially the confluence of travel, expense management, rewards and benefits is a really, really important and valid use case. You've traditionally had this massive dislocation between, or misalignment between an airline company, for example, that wants to issue a credit card and to be able to create loyalty amongst its end customers for people to redeem points on their card, but an inability to be able to marry up the loyalty side of spending with the ability to extend credit, how that credit is spent, where it's spent, and being able to track the two paradigms. One is how somebody earns those points and how much they get from those points, and then two is how they control and burn those points and where they spend them. BaaS companies are out there now integrating the two offerings, so that companies that want to launch loyalty programs with the addition of a credit card offering or a lending product on the side can now do so in a seamless way. Many of you may have British Airways credit cards or from other airlines, Singapore Airlines. There are many, many airlines that have sort of branded cards. These cards are now powered by banking as a service platforms, where underlying airlines can track and spend and adjust the spending patterns of customers. They can extend them credit. They can clip a ticket off the credit that's being extended by the underlying financial institution. So it just creates more revenues for the airline in terms of utilization, and then the banks in terms of access to credit to customers that they wouldn't ordinarily have had.
You mentioned that travel represents, a classic opportunity there. Mm-hmm. So what's stopping it from happening? What are the main barriers that are preventing this from happening right now?
I think a lot of it is to do with data privacy and ability, and the strong desire not to share information. I think data still the sharing of data and the analytics that can happen on it is still an area of contention when it comes to financial institutions, and when it comes to large corporates, large enterprise corporates, who are worried about what people will do with that information if it leaks, if it gets out, how it's used, where it's used, and heaven forbid, used by some of their competitors to target their end customers. So there's still a paradigm to work through around how data is analyzed, shared, and who has the rights over it.
Okay, really interesting session. I don't think we've got any questions from the physical audience here, so we'll end it there. Thank you very much, Aman Behzad.
Thanks,
Thank you.